Because you know I can't see anything. Welcome to Managing Cash Flow. Taking this class is an important step to building a better financial future for you and your family. As a small business owner, it is important to know how much cash is moving in and out of your business. You need to think ahead in order to meet financial obligations and run a profitable business on a long-term basis. This class introduces some basic cash flow concepts that can get you started. My name is Leah Crawford. I am the owner of Crawford Management Group. I am an accountant by trade, and managing cash flow is what we do. We assist our clients in understanding the ins and outs of their business. You received a packet, Kawana. You did email everyone a packet, correct?
Yes.
Okay, and you also said that you put a package, the link in the chat, correct?
Yes.
Okay, so we have a pre-test and a post-test that is in the package. So at your leisure, if you could print that up, and you can take the two tests just to see, well, take the post-test to see how much you've learned by listening to us today. I am excited to be here, excited to do this. This is my passion. I'm just happy to be here. I know we have some people online. Kawan, if you could introduce yourself so people can know who you are and what you do.
My name is Kawana Rutledge. I'm the administrative assistant at Urban Chamber of Commerce.
Okay. So who else? Brenda, if you could introduce yourself. I know Brenda's here.
Hi, I'm Brenda Bryant. By education, I'm told I'm an accountant. We will worry about that later.
Right.
I am an advisor for the Small Business Development Center.
And that's huge. That's huge. Is there anyone else that's on meeting that's in the meeting, Kawana?
Yes. I don't know who it is because they called in.
Got it. No worries. We'll keep it moving. We are going, well, I am very respectful of people's time. So we are going to try to stay on schedule. The agenda for the day is we did the welcome, the pre-test, you have it, you can do it at your leisure. We have our different learning objectives. We're going to do a case study, opening balance sheet, 3 views of cash flows, what Bob can do, a summary, and then you guys can give us an evaluation of this class. Ground rules. One of the best ways to learn is from each other. You probably have some great ideas to offer, so Brenda, I will be leaning on you. You also may know a process that works well for you and some pitfalls to avoid. Please speak up. Also, if something is not clear, please ask questions. As an entrepreneur, you always ask questions. That's one of the main rules for me that I always follow. Participant manuals. Each of you should have received a copy of Managing Cash Flow Participation Guide. It contains information and discussion points about this topic, worksheets for you to start in class and finish up on your own, and a toolkit of resources to help continue your self-education, including a list of agencies that provide technical assistance to small businesses. Please note, we will not have time to review the entire participation guide in class. We suggest that you review it in detail at your own time. What I can tell you is Brenda is an amazing resource at the Small Business Development Center. The Urban Chamber is an amazing resource. Our Business Success Center, it will be launching soon. So we have the resources to help you work through this entrepreneurial journey. Our learning objectives. We're going to describe the purpose of cash flow, and we're going to talk about it. When you're starting your business, cash flow is important because, money talks. And you have to get stuff done, so you need money. What is the cash flow cycle? What is that? What does that mean? And also help you to start to learn how to make cash flow projections. Again, projections are not actual. This is what you hope to accomplish. So, it helps you to start thinking about how your business and how the money will flow. We will describe a cash flow statement, and we can help you assess and improve the financial health of a startup. So, cash flow. The statement of cash flows is a statement that is used. I'm going to give you a little bit of background. I'm trying to go off script a little bit to talk about it. Statement of cash flows is one of the financial statements in your business. So what it does is it looks at your balance sheet and your income statement and combines them in a different way so that you can see how money is actually flowing through your business. The cash flow statement is split up in our world, in the accounting world, into three different categories. Operations, so we can see how well you're doing in your operations. Investing, we can see how well you are doing with investing in other things. Financing, seeing how good you are doing with people that are giving you money. And when you talk to an accountant, and our minds work a little differently when you're talking about a statement of cash flows, because we look at these three things, but we also can take those numbers and put them in different formats so we can see the health of your business. Let's introduce our company. So we are doing Bob and the Wire Cup. Bob's case, I guess in your book, it begins on page 4. But this is our realistic example to review a new business owner's cash flow management decisions. As we review Bob's cash flow issues, you may find that these concepts relate to your own cash flow questions. Okay, this cash flow is theoretical, and we're going to do our best to talk through this. Introducing Bob and the Wire Cup. Bob recently opened a new bakery cafe, the Wired Cup. The cafe has a great location in a small college town. To get started, Bob invested $30,000 of his own money and received a $20,000 loan from a commercial bank, and he spent $45,000 on startup costs, leaving $5,000 to run the business. So to go over that again, Bob, he had $30,000 of his own money, $20,000 that he received in a loan, that was $50,000. He spent $45,000 of that just in startup costs. So he has $5,000 left before he opens his doors to start his business. The Wire Cup is already popular with students, university staff, and neighbors. Everyone loves the coffee and baked goods. A college dean has started to order croissants for the faculty dining hall. Bob is building a great new business. However, Bob has concerns. He has not yet paid himself, and he wonders when he can. The $5,000 is almost gone. Given that his key customers are students, he assumes many will go home over the holidays, breaks, and summers. Questions Bob is now asking: how will he pay his bills if there are fewer customers? Will he have enough money to ramp up again in September? Should he buy in bulk to reduce costs? While suppliers allow Bob to buy on credit, will suppliers allow Bob to buy on credit, or does he still have to pay cash? The good news is that Bob is thinking ahead. He has time to find some solutions. As we review the Wired Cup's cash flow issues, you will be able to see these concepts, apply these concepts to your own business. Where are you in the cash flow continuum? Before we go on and learn more about Bob's cash flow experience, it will be helpful to learn your backgrounds and experience so far with cash flow management. Okay. Some of us are beginners. This is a new concept to us. We really don't know a lot about it. We're talking about opening up this business. We know we want to earn some money. We know we have to pay our bills, but we never really heard it talked about as a cash flow continuum. Some of us are intermediate. We heard of it, but we still have questions. We're okay at it, but we just have a few more questions. Some of us have been doing this for a while. I never like to call myself an expert, even though I've been doing this. I like to stay in a beginner's mind because I'm always open to learning and understanding how better to handle it. But in my arena, I would be considered an expert, but I still have questions. I still sometimes wonder, and I still sometimes have to think, do, and review. Brenda, when you were in business, where would you consider yourself?
Well, I go back to the clients that I have, and most of them are at the beginning stage. They're at the stage that says, I have an idea or I have several ideas,
Mm-hmm.
I need to know what the next step is. So part of the process is to walk people through a logical understanding of um, how a business person thinks versus how an employee thinks.
Mm, that's a good, two different ways, two different,
Yes,
two different ways. Delve in on that a little bit. How does an employee think?
an employee thinks that there is a salary that is always there. You may not like it, but it's consistent.
Yes.
And so you have the ability to look at your home expenses and to be able to come up with some kind of a spending plan that makes sense. When you are a business owner, your responsibility is to your business, your customers, your employees. And sometimes business owners forget about themselves. So they end up in a position where they're trying to make sure that the employees do get that steady salary, but they don't get anything. And so then the worry starts to build up because they don't understand how to use their financial information as a management tool.
Thank you. Thank you. And very amazing points, because you're right. As an employee, I get a paycheck every, however my paycheck comes, bi-weekly, weekly, bi-weekly, semi-monthly, and in some instances I've been paid monthly. But as a business owner, people look in and say, well, you're making money, but no, I have to manage this totally, totally different, because I need happy customers. So I have to have good product. I need happy people to serve these people. So I have to pay my employees. So it's a different conversation. It's also good to be around other entrepreneurs, because they might have creative ways for you to solve, things that you can do to make this work. I I don't know who the other participant is. Okay, well, we're going to keep on. We're going to keep on going. So we talked about that a little bit, but now we're going to go back to Bob. Balance sheets. So this is my world, and I lean back because I really get, this is my world, and it makes sense to me. But one thing that business owners, when I first asked them, do you know the balance sheet equation? Do you know what this equation is? And it's a simple math equation. It's A equals L plus E. So it's L. It's L. A equals L plus E. You have your current assets. So the A is for assets, and your current assets, cash, accounts receivable, anything that you have to, anything that's current. So anything within the next year, current. Then you have your fixed assets, and they didn't break this totally down. This is a very simple breakdown, actually, because they have current assets and then you have your fixed assets. This fixed assets are normally depreciable, right? So you'll have, for Bob, he has kitchen equipment, leasehold improvements, and office and technical equipment. A lot of mistake that I see business owners make is that they look at leasehold improvements and they try to expense them right away. And that's not how this works. Leasehold improvements are bulked together before your pre-opening, and they're depreciated over time. But that is a part of your assets, and it's depreciated to go on your profit and loss statement. Then for the liabilities. So liabilities also have long-term and short-term, which are current liabilities and long-term liabilities. Current liabilities, again, the same thing as current assets. It's anything that's going to be paid within a year. Rule of thumb, best practices is cutoff date is December 31st. If you have a calendar year in. So you always move current payments up to your current liabilities, right? Because you want to know what you are liable for currently for the next year. I use just a one-time adjustment for current liabilities just to make sure that I know, because there are ratios that you also do that you need these numbers. Long-term liabilities, anything that's a year or over. So if you're purchasing a building, if you have any other notes payable that are longer, all of those are long-term liabilities. The E is equity. The equity section of a financial statement is very important, and it also depends on your, is important, but it depends on your structure, how this equity statement looks. Because this one right here just has the owner's capital. But as you go into, as you've been in business for some time, it gets into retained earnings. If you're a LLC, you have basis accounts set up for each individual owner. So the equity section heavily depends on your corporate structure. So when you go into an accountant's office, they're asking you these questions because they want to know how to set up your equity section. Brenda, do you have anything you want to add to that?
One of the things that we try to work with clients on, especially when they come in looking for getting their business license, is having them understand the various legal entities, so that when they have that conversation with their CPA, tax preparer, accountant, that they walk in with that knowledge. I just came from QuickBooks Connect, the big conference that Intuit puts on for QuickBooks. And I ran into so many accountants who were saying that is such a problem for them, that they ask people, so what is your legal entity? And people don't know what that means. And once it's explained, they still don't know what it is. So
Got it.
that's one of the things that we really try to do here, is have that conversation early in the game so that people know the implications of what they're choosing. They're not getting an LLC because George is their cousin's neighbor in Jersey. And he said LLC is the way to go. What happens in New Jersey is according to that state's laws. What happens in Nevada is according to Nevada's laws.
Right. But the thing is that the GAAP compliance though is federal, is nationwide.
Mm-hmm.
And understanding the differences in the structures, like, are you a C Corp, which is a totally different structure, you have stockholders,
Right.
are you a LLC? Are you a S Corp? What is your structure? And then understanding that the S Corp is an election, that you can be a C for your state or LLC in your state, but you can elect with the IRS to be taxed as an S. So just understanding the differences. Are you just a sole proprietor? I went out, I sold some widgets and I'm just a sole proprietor, which is this whole totally different conversation. But understanding that this balance sheet here is taken from, you see the pre-opening expenses in the assets. And they have that listed as current assets. And I know some people look like, but no, these also go on a profit and loss statement. These are pre-opening. Business is not open yet. So they're putting them on the balance sheet because these are the pre-opening expenses. Okay. Very important to understand. Well, I look at everything from a tax perspective. Tax is my specialty. But in tax, I have to understand this because I have to reconcile this to my tax return. You have anything else you want to add before I go on to the next? That you see? And you see where I'll do want to add, you see where you have the accounting, advertising, and bank service charges are in one area, payroll taxes, and everything else. But the fixed assets are in another section. So with the kitchen equipment, the leasehold improvement, the office and technical equipment. And even with those things, as a business owner, you need to know what is the depreciable life on all these assets because it's different for each one of them. Okay. And rule of thumb, I use the tax. I always go to the tax code and look at it because I do most of my stuff is on a tax basis. And there will be a difference sometimes if you look at tax versus GAAP. But looking at this, just understanding how you classify stuff, because early on we said he had $50,000, he spent $45,000. This is how those numbers are broken down and presented on the balance sheet. If you look at the equity section, $30,000 of that was his equity. $20,000 in the liability was the $20,000 from the bank. And you see, even with the bank loan, part of that is current, the other part is long-term. So in the accountant's world, we ask questions because in our minds, we're trying to figure out, how do we turn what you did into this? How do we make this make sense? And from what the verbiage that they gave us, this now makes sense. And I'll move on to the next slide. Okay, a few notes about debt, and I'm going to read the slides and then we can talk about it. It takes some effort to obtain a small business loan, as we know. And as part of the process, you will need to provide a business plan. We do have a Money Smart module, Planning for a Healthy Business, which provides a lot of information about various ways to plan for a successful business. Knowing your credit score. The higher your credit score, the lower risk you are for creditors. For more information, attend the Money Smart module on credit and reporting. Banks have different criteria for lending. Talk with your local banker before you need the loan. The stronger your relationship, the more supportive they will be to help you secure a loan if you meet their lending criteria. The Money Smart module on banking services can help. Be prepared to personally sign for the loan. If a business is unable to meet its financial obligations, you will be held responsible. Again, if a business is unable to meet its financial obligations, you will be held responsible. Also, be prepared to pledge collateral. One last note, manage your credit cards to avoid high fees and interest. Business credit cards may be one of the most expensive forms of business credit. So understanding that when you talk about getting a bank loan, it's a lot that goes into it. You have to be ready, and the bank has to think that you're ready. They're going to ask you a lot of questions and you have to be ready to answer them. More importantly, you have to know where your credit score is. And if you're able to, I know some businesses that have gone out and gotten loans. I know some that just started and just worked it out. Now we're going back to the balance sheet. In total, Bob had $50,000 to spend to open the wire cup. He spent $45,000 on equipment, materials, and other assets as indicated in the balance sheet. That's the $15,000 in current assets and the $29,500 in fixed assets. If I were Bob's lender, a potential business partner, or a vendor, I would look at this opening balance sheet and ask the following. Has he invested enough of his own money in this venture? Huge questions, because I can't tell you the number of people that come to me and say, I want to start a business. Is there a grant out there for me to do it? I just look and I'm like, say that again. I want to start a business. Is there a grant out there to do it? Say it again, and they repeat it again. And I just keep on going back and forth with the question, because if you don't have any skin in the game, most people won't invest in you and banks won't lend to you. Did he finance the business wisely? For instance, does he carry too much debt? The terms and time requirements for loan repayment can make a huge impact on cash flow. Did he wisely spend the $50,000? Is there enough available cash left over for him to run the business? Is $5,000 enough to carry him through a 6-month period? These are questions that, and I even have some more, but these are questions that you'll be asked, because he has spent 95% of his money, 90% of his money, and he hasn't opened the doors. Consideration, can he operate? It's a coffee shop. He needs employees. Can he operate? What are the hours of operation? Can he operate? What is the menu that he will have to supply? Because I know for me, dislike going into a store, especially a Starbucks or, you know, a small coffee shop, and you order something and they say, well, we don't have that on the menu today, or that's not available. Does his menu, does he have a lot, does he have the supplies to cover his menu? Then you have to guess, because you don't know what people are going to order. So they might order all your croissants and you're done, but nobody ordered a cupcake. And you made a bunch of cupcakes that are just sitting there. So you have to have just amazing projections when you are doing this type of business. You know, we don't have time to discuss all the questions and the answers in details. I am just explaining that an opening balance sheet tells a story which can prompt constructive dialogue with stakeholders. A balance sheet tells a story, but it's just the first chapter. The story continues into the cash flow statement. Any questions? Brenda, you got anything you want to add?
No, I think that was good.
Okay. 3 views of cash flow. Look at these 3 views of cash flow: a cash conversion cycle, a cash flow diagram, and the World Cup's cash flow statement. Combined together, these 3 views provide a comprehensive view of a cash flow system, and we'll go into detail. The cash conversion cycle. The cash conversion cycle consists of 3 components. A business pays for raw materials. A business makes a product or service using those materials. The business sells the products or services. The trick is to know how long it will take to complete the cycle. The rate of conversion impacts cash flow. If you have a short cycle, you will sell the inventory and turn it back into cash quickly, which puts money back into the cash flow system. If you have a long cash conversion cycle, you will not be able to use that money in inventory because the inventory is sitting on your shelves. Let me say that another way. I sell, I have a tax practice. So my cash conversion cycle, I buy my tax software. The first time I sell a tax return, I'm making my money back. So if I pay, say I paid $2,000 for a tax product that does tax returns, how long is it going to take me to earn my money back? So I pay the $2,000 out. I don't do my first tax return and say I charge $200 for a tax returns. It's going to take me 10 tax returns, in order for me to get even the investment into the tax return. That's what they're talking about. How fast are you turning your product into money? This right here is using inventory though. So for Bob, I have to buy flour, I have to buy sugar, I have to buy all these raw materials in order for me to even make my product, right? So I buy all these raw materials, I spend that money on Monday. I go into the kitchen and I produce all of this stuff to make my product or service. Then I have to put it on the shelves. If I put it on the shelves and it sells, then I have money in. But if I put it on the shelves and it sits, is my money wasted? Or did I make good decisions in what I made? So it's a consistent money out, money in, money out, money in. If you have a long conversion cycle, you will not be able to use the money while inventory is sitting on your shelves. Said that again for a reason, because you want to be very conscious, especially when you're like clothing businesses. They're not buying raw materials, but they are buying clothes. So in a clothing business, you're guessing what people like, right? So I'm a Macy's buyer. I'm buying all the stuff to put in Macy's because I'm hoping that you'll come in and you'll purchase these things. If you don't purchase them, okay, so now I have to put them on sale. I have to do different things because I have to turn that into money. The cash flow diagram. Another way to describe cash flow is with this diagram. It's on page 7 of your participation guide if you have it. We will review the diagram to get a big picture of cash flow and how all of the elements, the pipes and the valves work together. Now, guys, I know when I first looked at this, I was like, oh boy. I was laying down and I kind of listening to TV, well, leaning back, I should say, because I was in the family room. Listening to TV, and I was like, wow, this is a lot. It's a lot. But this is actually what goes on in my head on a regular basis. If I had to put a diagram to it, this is what goes on in my head as an entrepreneur, because I am consistently, thinking about my cash flow. So let's talk about this diagram. This diagram is a representation of how cash flows in and out of the system. It depicts many decision points or valves you control. When you start a business, money flows into the business via debt or equity. Again, that's my L and my E, my liabilities, my equity, my debt or equity. In the case of Wireco, Bob had $30,000 of his own money invested in the business, the equity bucket. In addition, Bob borrowed $20,000, the debt bucket. So let's see if I can see that on here. So this is my debt bucket. This is my equity bucket. And you see my valves coming from my debt and my equity. Okay. The valves in this cash flow diagram represent decision points. Your decisions impact cash flow and increase or decrease your probability of success. Some valves are open all the time, such as sales tax payables and debt. You have to pay them. They are a constant drain on your cash flow, which is why they are at the bottom. So let's see if we can find that. So we have collections, available cash accounts payable. See, you got your sales tax and your debt. See how they dripping? They're just dripping. Okay. And I think, can you see my pointer? Okay, you can see my pointer. Okay, just want to make sure. All right. Some valves are partially open, like sales, general, and administrative valves. What you spend is up to you. As you spend available cash, the balance in the center tank drops. So you got these things right here. So these drip all the time. These, you open up and close them right here. All right. Inventory. So let's find inventory. Inventory is here. Inventory. You spend money on raw materials, labor, and other direct costs to produce to sell, assuming you are producing a product. The same principle applies for services as well. If you spend a lot of money on inventory, you tie up your money until you sell the inventory and turn it into cash. So again, see how we got the turn thing on here? So you tie up your money in here. All right, in inventory. Fixed assets are usually expensive. Yes, they are. See my fixed assets here? All right. Buildings, upgrades to space, vehicles, equipment, computers, and technology. If you purchase an expensive fixed asset, it ties up cash. A better option may be to lease it right here to keep the cash flowing. Profit generator, my sales pump. See up here, my sales pump. I like the profit generator, the sales, right? The sales pump. In the top left corner, you have a sales pump. Keep this primed to pump sales back into the system, because I need to pump the sales in order to get the water I need the sales. See, I'm pumping to get my sales, because my sales pay all of this stuff, right? But with sales, I might have some people that buy on credit. So now I have an accounts receivable, right? That means it's going to take me longer to get this cash. I made the sale, but I'm not getting the cash yet. So I don't have available cash. Some of that is like accounts receivable. And if I collect the money, that's good. But if I don't, that's bad credit. Got to write it off. Money goes out. It dumps out. All right. So accounts receivable. You may make a sale, but not receive the cash until you collect it. Ultimately, you want to convert AR into cash, so it flows into the center tank and becomes available. My center tank, my available cash. So some AR will not be paid. That is called bad debt. This is my bad debt. This is my bad debt up here. Bad credit. Bad credit. And some people have bad credit, bad debt. After 90 days, an AR will not some AR will not be paid, so it's called bad debt. Usually after 90 days, an AR will not be paid. When you extend credit and create an AR, you need to follow up to ensure you receive that payment. So now you're using your people to call people so that you can collect the money from the accounts receivable so you can put it in your available cash. All right, accounts payable. In the center tank, accounts payables are represented by bricks. It's your accounts payable. This is money owed to vendors and suppliers who extend you credit. For example, you receive a product or service, but you have not paid for it yet. You still have use of that money. The bricks elevate the water. Instead of having to pay for the product or service, you can use that money for marketing to pay another bill. It is challenging to balance accounts payable and accounts receivable. You want customers to pay you as quickly as possible, cash in, and you want to pay your vendors as slowly as possible, cash out. Ultimately, you want to have and be generating excess cash flow from profitable operations, or ECFPO. That's here, that's the shower. Of course, in business, we would not use a diagram. We use a statement which tells the story with numbers. So we went through this diagram, very colorful, I think, very good diagram, but also starts a good conversation because you can see how you're managing stuff. If you think people say I'm bleeding money, you can see if you got payroll taxes, sales taxes, some debt, your general and administrative expenses. I mean, all the stuff that actually you have to spend money on. It's all here. It is challenging to balance. Ultimately, we want to have generated. The broken pipe represents, let me go back to that. The broken pipe represents how depreciation, that's here, how depreciation can be used to reduce your taxable income. We won't get into that in this class for time management issues, but this is a good question to share with an accountant. This diagram represents a cash flow system and decision points you control. This is huge. And I think I repeated the same thing, and that's okay, but this is huge. Next, they're going to ask you to turn to page 10. So I'm looking at page 10, and it's very, very, very complicated. So if you have page 10, please look at it, because it is the statement turned into numbers. The cash flow statement is a valuable decision-making tool for business owners, investors, and creditors. It allows everyone to make smart, informed decisions about your business. In this example, Bob made projections based on 2 months of actual experience in August and September. He does not know how much seasonality, summer vacations at the college, will affect the business. He assumes the impact will be significant. The first column, and if you have a participant guide, I would encourage you to turn to page 10, because there is a full cash flow statement, and I'm going to talk you through it. You can pause the video and get page 10 so you can look at it, so you can understand where the numbers are coming from. The first column lists the money in categories such as loans, receipts, owner's capital, and so on, and money out such as operating expenses for accounting, accounts payable, debt, advertising, and so on. The second column represents an opening business balance sheet startup costs. You would not typically see this on a cash flow statement. We include this information to demonstrate how elements of an opening balance sheet transfer over to the cash flow statement. The rest of the columns represent monthly income and expenses, as mentioned before. Bob has 2 months of actual expenses. Based on what he knows so far, he projected income expenses for the rest of the year. Notice that Bob had $5,000 in available cash. His sales were $25,000 and sales tax was $1,563. A note about sales tax: put this in a separate bank account. Do not commingle tax money in your regular bank account. You are collecting tax on behalf of the government. This is not your money to use. Again, this is not your money to use. Most likely, you will be required to pay this quarterly or even monthly to the government. The payroll taxes rate used is example of 15%. You will need to determine the appropriate local, state, and applicable federal taxes. So I'll say it again, sales tax. Your sales tax is not included in your sales. It is payable. Your customers pay you, you pay the government. So I buy something, and we do it all the time. You buy something, it says $100 on the tag. Well, $10 on the tag, but you pay $10.80. That 80 cents is sales tax. You're paying that store. That store is then remitting that money to the government. So you're like a trustee. In August, the wire company had a total inflow of cash of $26,563. 25,000 was sales revenue plus $1,563 of sales tax. That means at the end of August, Bob's total available cash was $31,563. That's the $5,000 that he had from the beginning, $26,000 that he brought in. So now he has $31,000. But remember, $1,563 of that is sales tax. So that gets remitted right to whatever sales tax agency he has to pay that to. Okay. If we look at the bottom of the spreadsheet for August, we can see that $29,253 was the cash outflow for the month. Some cash outflows are fixed month to month, such as Bob's lease payment, $1,350, and the cable and internet payment of $200. Some cash outflows are variable, such as advertising and utilities. Variable amounts fluctuate from month to month. You may have some control over cash flows in and out of your business. For example, the sales. You decide what you will sell, where, to whom, how, and at what price. The same goes for expenses. You can decide what space to lease, how much debt to carry, when to advertise, when and how much raw materials to purchase, and how many staff to employ. In August, Bob has available cash of $31,563. The cash outflows of $29,253 will leave him $2,309 in his bank account at the end of August. This $2,309 becomes the beginning balance for the month of September, and the process starts all over again. Brenda, did that make sense to you? Okay.
Yep.
All right. Yep. In September, he starts with $2,309 plus the $27,000 in sales. Let me look at the page again. Plus the $27,000 in sales and the $1,688 in sales tax. So total cash available is $30,997. Cash dispersed was $29,778. So if you subtract those two numbers, the difference is $1,218. So he will begin October with $1,218. If you notice something, he's losing money because that $5,000 that he started with is dwindling down. Got it? And if you look at it, you can see where the money is going. To sum it up, Bob is happy. The wire comp sees that you do well, but he is worried about the rest of the year. He projects that he will be able to pay all his financial obligations, but he will be cutting it close because he's seeing that the money, the 5,000 is dwindling down. Some business owners overestimate revenue and underestimate cost. I will say that they overestimate the revenue because they think they're gonna make a lot of money, but then they don't look at how much it's really gonna cost them. So they underestimate the cost. This means they will at some point have a cash flow crunch and will not have available cash to meet their obligation. To prevent this, consider developing a couple of cash flow statements. Best case scenario, this would be an ideal situation where all your dreams come true. Worst case scenario, this would be a much more conservative scenario where you do not get the sales revenue you would hope for and costs are higher. And most likely, this will be the Goldilocks story. Not too hot, not too cold, but just right. It is most likely scenario somewhere between the best and the worst. In this example, Bob created a most likely projection, given he knows the students and faculty leave for vacation in July, and he projects a negative $4,316. You can have a negative cash situation. Negative cash means you cannot have a negative cash situation. Negative cash means game over. Again, you cannot have a negative cash situation. Negative cash means game over. What you want to achieve is excess cash flow from profitable operations. This is when you can shower yourself with some cash. Bob needs to turn some valves wide open and turn down others in order to hold on to his cash as long as possible. If you were Bob's advisors, what would you advise him to do? How can Bob increase revenue at the wire cup? How could Bob negotiate a better deal or two with his vendors or suppliers? How can Bob plan for seasonal ups and downs in his business? Is it wise for Bob to use a credit card to offset cash flow issues? And these are just several questions. Brenda, you have any questions that you would ask?
You know, I when I look at a cash flow, I tell my clients this is like your wallet. If there's money in it, you can actually spend it. If there's not money in it, you cannot. You I want them to understand the importance of tracking their money, because if you don't track, you don't know what you have, and if you don't know what you have, you make decisions that are not based in fact.
Mm, And you want to base your decision in fact.
Absolutely. This is one of the wonderful tools in the management toolbox. But if you don't understand that it is a tool and how to use the tool, then you get yourself in trouble. And that's why the conversation with your financial professional is so very, very important, because you need to come to the table with as much tracking information as you can have and as many questions as you need to ask so that you can use this in its appropriate manner.
Yes. Yes. I love it. I love it. Possible ideas for Bob. Note that some of the ideas you suggested are on the slide. And we could have some, have some other stuff. Bob can increase cash flow of revenue into his business. Bob can reduce outflows, perhaps by making arrangements with the vendors or his landlord. And I know that's a key one. And we saw that during COVID. Landlords, people were making negotiations with their landlords because money wasn't coming in. So they talked to I know I talked to my landlord. My landlord, while I still had to pay rent, he did not increase my rent in my office space. And it was a good conversation. Bob can pay his entire, if Bob can pay his entire rent for 2 months, he will pay more during the 10 busy months and no rent in July and August because he's slow. So that takes away the rent expense. So take the July and August rent and take it over time, right? So it's paid all in June, but in July and August, when it slows down, he doesn't have to worry about that outflow. Also with staffing, he doesn't have a lot, it's slower in July and August, and which might work because he might have college students working for them. They go home in the summertime. They come back in August when school starts back up. Reduce your hours in the summertime. So there are a whole lot of different things that we can talk to Bob about. But as a business owner, and I tell people when you go into business, especially for us parents, this is your baby, this is your child, and you are nurturing this child. You're trying to make good decisions so it can be profitable. I know for me, I tell my children, I raised a grown woman, and now I'm raising a grown man, and we got to make good decisions on a regular basis. Plan, do, and review. We have to look at the money, look at your outcomes, and figure out what do we do better. What did we do well that we can keep on doing? What did we not do well that we can improve on? And the money tells a story all the time. Tells a story all the time.
Leah,
Yes.
Diane said, finally, cash flow statements have been explained simply And now I understand how to use them to my business's advantage. Take a
Thank,
bow, Leah.
thank you. Thank you. This is honestly, this is actually one of my favorite, this is one of my favorite statements. Um, and it's the one that is the least used. This is the one that is the least used. People go to the profit and loss statement. Profit and loss statement, it tells a story, but not the whole story. Some people, I want to see your balance sheet. Okay. Tells a story, but not the whole story. The cash flow statement is a different story. Let me give you another example. So I use projections because I know how much I charge for my services. So my staff knows how many clients we have to service every month in order for us to meet our projection. And the months that we don't, and I'm like, well, y'all, we didn't, months we do well. Okay, so we talk to more people. We got it done. But months that we didn't, over the years, we didn't talk to enough people this month. That's why we did this. And then dealing with the accounts receivable and the accounts payable. Most people don't do tax returns on credit. It's a reason why, because that's one service that once people get it, it's hard to catch them afterwards. So we cash and carry, and we had to implement a policy. When you come in the office, you need to leave some money here, and before we file it, you pay us. And I sat in a room with CPAs that said the same thing, CPA level. When our clients come to pick up their return, we require them to pay us. We don't do accounts receivable on tax returns. Bookkeeping service is a little bit different. It's a monthly retainer, quarterly retainer. We require you to pay the retainer, and we ask nicely, but we're talking to you about your financial information. And in order for us to keep on talking to you, you have to pay us so that I can pay my people, so that everybody can be happy in the process. But thank you again for the compliment. I appreciate that. This is possible ideas for Bob. I think we did that. What not to do. Hey. Never use your sales tax money as your financing plan. I'm going to say that again. If you are in a business and you are collecting sales taxes, put that money in a different account. Do your forms at the end of the month. Remit those payments to said government. Okay? It's a risky bet, and the penalties are high for not paying those taxes on time. Don't pay your vendors late, because that can cut off your supply chain. Do not overestimate your revenue, and do not underestimate your costs. If you estimate that you may be late or miss a payment, talk to your loan officer as soon as you are aware. People, you got to remember that when you're dealing with creditors, vendors, you're dealing with people. And I also represent people in front of the IRS. And when people come into my office, oh, I'm scared of the IRS. Well, the IRS agent is a person, and they live life. So let's go have a conversation with the person, and let's figure out, we can talk about, what's going on. You can talk to people, and just as long as you are able to describe what is going on and you have a plan to work it out, most people will work with you. But if that is your consistent, you can never pay your bills, maybe being an entrepreneur is not the lane for you. It is okay to ask for help. As an entrepreneur, I've had to ask help. Help with tax questions, help with just help how to do things, how to finance my business, how to grow my business. And people gave me some good advice on how marketing was not my strong point, but they gave me some good advice on marketing. I didn't know what I didn't know. Now I'm learning, I have to talk to people, get out there in order for us to meet our business goals. It is not a sign of weakness if financial management is new for you. Find a great accountant. Brenda and I, but we're both great, amazing accountants, or a technical advisor at SBDC or SCORE, who can explain cash flow in ways that relate the concepts to your own business. An accountant will encourage you to use your computer to manage your cash flow documentation. If you do not already use a financial management software, take a course to develop the skill. You will also need to manage your paperwork in a professional manner. Set up a reliable filing system to keep track of all your financial documents, such as tax forms, receipts, invoices, and so on. Co-opetition is a real term. Competitors can be good advisors as they cope with the same cash flows issues that you do. And I said co-opetition. Find ways to cooperate to share information with them. They have experience to share. Check out the toolkit of resources in your participation guide for ideas about where to locate technical assistance. Again, ask for help. You know, even though you're competing with somebody, you're also cooperating. Have you ever noticed that, when you go to a mall, they have a food court? Everybody's competing. A mall has a whole bunch of clothing stores. Everybody's competing. I'm sure they talk to each other because if you go to fashion show, Dillard's is having a sale, all stores might benefit because Dillard's is having a sale, they're bringing in the people, they might walk into the mall and see the other stores. So either we're in competition, we're also complementing each other with our services. Key points to remember. Managing cash flow is a core competency of small business ownership. A balance sheet tells a compelling story. A cash flow statement continues that story. Use it to monitor projected and actual income and expenses. Plan for seasonal fluctuations. Every business has ups and downs. Ask some of your competitors when their usual slow times tend to occur. Try to maintain a rapid cash conversion cycle. Try not to tie up too much of your cash in inventory. Lease equipment instead of buying it. If you do not buy equipment, buy used whenever you can. Manage your paperwork like a pro. Your accountant will expect to see spreadsheets, an accounting program, well-organized receipts, invoice, financial statements such as banking and credit card statements. Ask an accountant for advice. Ideally, this class has helped you prepare for a series of helpful conversation. I can tell you that the more information you have, the better your conversation is. I love it when our clients come in with a list of questions and we can jargon back and forth because I know that they've thought about their businesses, how they want their business to go, and strategies and plan, like our think tank. The toolkit in the back of your participation guide provides helpful information such as a glossary of common cash flow terms, a sample of a cash flow template, tips for negotiating better terms with customers, vendors, and suppliers and landlords, and a great list of resources where you can get more information. Many of these are free and very, very inexpensive. But I can say that SBA has a cash flow statement, cash flow sheet that is amazing. Kawana, I will try to get you a blank copy of that. I got it from the SBDC
Okay.
from SCORE so that you can have it in your toolkit. But it's an amazing resource for entrepreneurs if you're in business, just so you can manage your cash flow, manage your products. And it's for service businesses, product businesses. It's an amazing tool. I will get it to you. Maybe we'll go over how to use it, but I use it and I use it with my clients in order to manage their cash flow.
Okay, thank you.
Okay. We have a post-test evaluation. Again, like I said early on, because this is an online class, take the pre and post to see if you learned some stuff in this class. I hope you have. It was my pleasure to work with you, to talk to you today. My name is Leah Crawford. I am the owner of Crawford Management Group. We offer a variety of service in this financial arena. I am an accountant by trade. We do taxes for personal business, and we also now do trust returns and nonprofits. We are a doc prep service, so we can help you prepare your documents. And we are registered with the state of Nevada. We are also notaries, so we notarize documents as well, and we can also come to you. We have been in the Valley now in business for 15 years, and I am happy, proud. I work with a group of amazing women that they do their best to provide an excellent service. Again, it was my pleasure. Kawana, I give control of this meeting to you.
Thank you. Thank you all for attending. You all have a nice day.